have a diverse set of things I want to share with you. I'm going to begin with Peter Grandich, who I have never heard of. I'll explain later, but I was very impressed by what he had to say and his issues, the 5 issues that he believes will lead to the next Great Depression. Well, that's a huge statement, but I'll unpack it for you later. Then I'm going to go into a small piece from David McElvaney and his podcast. I know some of you listen to him. And then Kate Rooney at CNBC talks about tech layoffs, which are seeming to be increasing. And then I'll give you someone who will talk about the positive side of what they see coming for this year in the market. So a wide range of items, but they're all interesting to me. As I dig through my pile of information, I'm trying to find things that are interesting to me that I think will be interesting to you. Today is April 23rd, 2024. My name is Ben Reppond. Welcome to my YouTube broadcast. As I look through this pile of information, charts and videos and so forth, trying to find what was interesting to me that I thought would be interesting to you, I came across a video from a guy named Peter Grandich, and he is being interviewed by David Lynn. David Lynn is a podcaster, very, very good interviewer from Canada, and he has interviewed him before. He interviews top people. Grandich is on Wall Street, has been for 40 years, and did a great interview, and so I'm going to play it for you. Grandich is what I call a second-tier person who is on YouTube. He's not really a self-promoter. He will submit to interviews, but he doesn't go out there with his own podcast. And on Wall Street, I'm sure he's known. But he's not one of the people you see on there every week. But his track record to me, was impressive. He's a very humble person, but he's accomplished a lot. He has been on all of the financial shows. He has been in print on, Wall Street Journal, Bloomberg, etc. A lot of material over the years. And he is because he's credible. But he doesn't seek that. Again, I think his humility was what spoke the most to me. When he spoke of the 5 issues that will lead us into the next Great Depression. He says maybe even greater than the past one. Well, that is a huge statement. So, because the last one was horrible. But the issues that we're facing as he unpacks this, they are very, very significant. More significant, in my opinion, and in his opinion, than what led into the Great Depression. So he'll cover these. I'm just going to summarize them and then listen to his explanation. The first being U.S. debt. The U.S. is $33 trillion in debt and climbing, $1 trillion to $1.5 trillion a year. 800 billion of that is interest, partly because the dollar amount has gone up, but partly because the interest rates have also gone from virtually nothing up to 5%. And we have not paid down any debt in a long, long time. And we have no plan to pay back $1 of the debt or to pay $1 of the interest. It just keeps piling up and piling up. This will not go forever. It is not designed to go to the moon. You can't just pile it up. Congress acts as if it will go to the moon. They don't seem to mind spending money here and there. There's never a question that I've ever heard of how are we going to pay this back. Now, you run a household budget. I run a household budget. If you have debt, you think about how to pay off that debt. That's the way you should think. We as a country don't think like that. I've never read anything that says we think like that. So that is an issue. because at some point, as you know, just like with your household budget, the debt will crash you down. It'll crush you. And so will it our country. And if we are among other countries that it crushes, which we are, then it will crush all of those countries. And maybe this will be what's called the Great Reset, where all of the currencies and all the economies get reset. But in the process, when debt collapses countries, particularly first world countries, I don't know how you avoid a Great Depression, because that seems like the inevitable consequence. Secondly, he points out, this is kind of the same thing, Social Security. Social Security is headed for a cliff. The cliff is about 9 to 10 years out from here, where we will not have enough money in the Social Security Trust Fund to pay the promised benefits. It won't go to zero, but it will come down. How many people, seniors, are living on, counting on their Social Security? Millions, perhaps tens of millions. What will that do? You combine those two, and it's a horrific scenario. And Congress does not have the political will to deal with either issue. They do not. So if they did, they would fix it now when there is an easy fix. That I can think of 2 or 3 things that could be done that if you do them today are not a big deal. But they won't do it. They will wait to the last minute, and then it will be very consequential. Thirdly, immigration invasion. We know that we are getting invaded, if you will, not with guns and knives, but with economic people seeking a better life for themselves and their families. They're coming into this country. Millions are coming in, and we don't have a plan or a way to assimilate them into our culture. So that is another tidal wave that is coming in that we have not dealt with. The BRICS nations, they are Brazil, Russia, India, China, and South Africa are, they call it BRICS, an acronym, and they are trying to find a way and have found a way to divert doing business in their currencies, or maybe the IMF currency, but their currencies, and circumventing the US dollar, trying to prop up their currency with transactions and diminish the US dollar. They are not backed by, they're just paper. They're just like us. They're paper currencies. They're no better. China, meanwhile, is building up, they're buying every ounce, every amount of gold that they can buy. So is Russia, and so is India, but China, Russia, India in that order. And they are accumulating thousands of tons of gold. And that gives, they're not the best currency in the world, certainly, but it gives a degree of legitimacy. When have we bought, in the last 50 years, when have we bought an ounce of gold? If you can think of one, please let me know. I cannot find any evidence that in 50 years we bought 1 ounce of gold. So meanwhile, we keep printing money, and against the same amount of gold that we had, which was diminished about 50% following World War II, diminished down to about 8,000 tons, and from 16,000, and we have not added to that. So what does that do? It has taken the dollar from the establishment of the Federal Reserve in 1913 to pennies on the dollar, 4 cents, 5 cents approximately on the dollar compared to what it was worth in 1913. Why? Printing of money, issuing of new dollar bills in paper, and backing it by nothing other than what was already there. So that's an issue. And finally, this is an interesting observation. This is why it just made me pay attention to him. The political polarization. And he says we've got the left who is moving further to the radical left, and the right that is moving further to the radical right. And so now you've got the right and the left more further apart, and they won't even talk to each other, work with each other. When have you seen a true bipartisan piece of legislation or attempt to work together? No. They refuse to work. If this side's for it, this side's against it, and vice versa. It's so the problem that he sees, that I thought this was interesting. So if you see that we're headed towards some kind of a collapse or a reset or um, disaster economically. We are headed to that at some point. And he doesn't put timelines on this. But if we are, it's going to take Congress and the Congress and the president to all work together, both parties working together to solve it. Think Great Depression. Think of, a major catastrophe. Okay, think of the Civil War or World War II, things like that. This took a bipartisan effort. And as a country, generally speaking, we rose to those occasions. His concern is that today we are so polarized we won't be able to do that, making some kind of a catastrophe worse. Very interesting observations, and he says it very thoughtfully and very humbly. So I thought, I'm just going to let you listen to this. It's 3 or 4 minutes long, and I think you'll like it. And it kind of sets the stage for our thinking. So as you think of your life, you think, okay, what can I be doing? How can I be preserving my capital? How can I be living within my means and doing more with what I have? And if we face something like this, how do I deal with it? So those were his thoughts as he ended this piece. But take a listen to Peter Grandich.
Fair enough. Let's talk about this financial arc you mentioned earlier. Let's come back to that. My question is why? Why are we building a financial arc? What troubles you today about our economy and our financial prospects?
So what's left of my livelihood in my 40th year is part of a planning group here in the U.S. and I'm the big picture guy within the group. And the beginning of the year, I just concluded that there were 5 serious issues that were going to lead the United States into an era where it would be as difficult, if not more, than it was during our Great Depression. And those 5 issues, and I'll just name them if you want to discuss them, that's fine. If not,
Yes.
first and foremost is the debt issue. We're getting to the point now where paying the interest is going to be a challenge. We're finally seeing, by the way, if I may add, Dave, and I'm glad to see it, we're finally seeing titans of business and within the financial communities worldwide bringing that up. Even the IMF spoke about it today. That's a very serious issue. The ability to even pay our interest, let alone forget about ever paying back the principal. The second issue is, I've talked to you about it before, and that's an increasing retirement and aging crisis. 65% of Americans are working paycheck to paycheck. They are all going to need to work older into life. They're going to need more support as they get older. So that will be an economic strain and a struggle. The number 3 has moved to what challenge number 1 in recent days and weeks. And I said back in January 1st, we were under here in the U.S. an immigration invasion. And I called it an economic invasion. Not that people are coming with guns or knives, or the vast majority of people are coming are just looking for a better life, but they're coming with just the clothes on their back. And so the economic cost to that, which we're seeing now just in a few months, paralyze major cities, New York, we just seen it, and others, that was going to continue to be another economic, social, and political problem. The 4th is the BRICS. You and I just discussed it, so I don't have to go over that. And then the 5th is the one that you would hope could fix the 4, but it's the most broken of them all. And that's here in the U.S. We have political paralysis, Dave. The Democrats and the Republicans, the 2 major parties, cannot work together in any rhyme or reason to perform and do any of the things necessary to be done. And the compounding of that now is each party has a fraction in their group, which is splintering away. In the Democrats, they're moving to more to the left, and in the Republicans, they're moving more to the right. So someday when all this hits the fan, which seems to be sooner than later, the political will to do the hard stuff that would be needed to try to correct this, or at least slow down or stop it from getting worse, isn't there. And therefore, to our clients, you need to have a financial arc. And the theme of the arc is this, besides less is more and live within your means, is that governments are only going to have 2 choices, whether in the federal level, state, or local: raise taxes and cut services. So you're going to be more needed to fend for yourself. And in order to do that, You need to make sure you had the proper savings and live within a means to when those hardships come, you don't get penalized as other people will because they're overextended. And the simplest sentence that I use is capital preservation now is more important than capital appreciation. Doesn't mean you give up on capital appreciation, but you need to make sure first that your capital preservation is taken care of. And then if there's excess, we can look at capital appreciation.
Now, some of you listen to David McElvaney. He is very credible. He has a financial firm in Colorado, and just a very smart individual, and he has a global perspective. If not, you can listen to him on his podcast, McElvaney Weekly Commentary, and I do recommend it. So in this past week, he had a piece on there that he began with, and it was that the insiders, now think about this, insiders in publicly traded companies, this is the CEO, CFO, CIO, whatever, people at the top, people in the corner offices, they are selling their stock in their company, of which they own some, 50 times more than they are buying. So if you work for a company, do you believe in the company you work for? I would think so. If you do believe in them, why aren't you buying their stock instead of selling it? 50 times more selling. Think about that. What does that tell you? It tells you, to me personally, each one is a different story. There's a reason to sell stock other than you think they're in trouble. There could be they want to diversify, they want to raise some liquidity for themselves. I understand those reasons. But when it's 50 times more, it tells you they see storm clouds. They see concerns for their company and maybe the economy and maybe the market that they are not telling you and I about. Interesting. So take a listen to this, a very brief piece from David McElvaney.
Welcome to the McElvaney Weekly Commentary. I'm Kevin Orrick along with David McElvaney. David, we just got out of our meeting and Morgan was talking. He said many things that were shocking, but insider selling on the stock market right now. There's somebody in the know. Morgan was talking about you don't want to be playing the old game when the new game starts. And there are people who are playing the new game right now, and they're the insiders. Insiders are the tops of each of these corporations, and they're liquidating stocks at a pace 50 times more than they're buying. They know something that the markets aren't really showing, don't they?
Well, the market is coming awake, at the edges anyways, to a number of fresh realities. They're not fresh. They've been here in plain sight, but they've been ignored. And so the obvious things are beginning to sting. Michael Hartnett talking about inflation.
He's with Bank of America, isn't he?
That's right.
Yeah.
Really sharp guy. And as we've been saying, we will see interest expense, which is absolutely mind-numbing. $1.5 trillion this year. And he says, unless we lower rates 150 basis points. Actually, he raises the number to 1.6 trillion. And again, this deals with the maturity wall we've talked about for weeks, this idea that we have trillions and trillions of dollars that have to be refinanced at higher numbers, and it is consequential. It's consequential for our fiscal picture. It ultimately is consequential for the US dollar. But in the short run, it's just a stress and strain on the Treasury.
Well, and he said something else that really was fascinating too. He said we can no longer allow the markets to set interest rates. That's when you're backed into a corner, when you can no longer let the market do what the market would do.
So Kate Rooney covers the tech industry from San Francisco, and she's employed by CNBC. So she gives a report, kind of here's what's going on in San Francisco related to the tech industry, which is kind of nerve central for tech. And she talks about this concept. They're laying off people. They're laying off a lot of people, thousands, tens of thousands of people. And she talks about this concept of stack ranking. This was first coined by Jack Welch, who is mentioned, and his concept was that it's a very harsh concept, but where every year you lay off the worst 10 to 15, you cull out, lay off the worst 10 to 15% of your workforce, kind of making your workforce better and better and better. And it's horrible for the people who are working, for they are doing their best. They may be in that 10 to 15%. Maybe they're not slackers, but they're not in the top tier, or maybe they're not in the top 2 or 3 tiers. They're good employees. I hired, when I sold my company, at that point, we employed about 110 people. So not a very big company. And I had people who worked in the mailroom, who, a receptionist, administrative person at a low level that nobody noticed. These were good workers. I appreciated all of them. They worked hard. It would pain me, I've just got to tell you, it would pain me to have to lay off the lowest, to identify and then lay off the worst 10 to 15%. I would be laying off probably people who didn't deserve it, but also people who I valued. So it's kind of a cutthroat approach. So I talked to my son about this. Now, my son, Preston, he works in the Bay Area. He is in East Bay, east of San Francisco, but it's the Bay Area. And San Francisco and that area is tech heavy, and there are tech people everywhere. So I said to him, as I was looking at the price of silver and gold skyrocketing, I'll cover that tomorrow, and I said, the spot price is going up, but the markup is not going up. And I said, what's going on? It would assume to me, when we've had times like this in the past, I think of 2021, and they're lined up at the door. They were lined up at the door for him when he would open the door in the morning. Customers galore. He said, not now. I said, that's interesting. Why? Why do you think? He said, I can tell you, Dad, they don't have any money. Or they fear being laid off where they won't have any money. And it's pervasive. Now, he said, I have some very big customers who have, buying hundreds of thousands of dollars in gold and all that. I'm not talking about those people. But the average person who comes in to buy, a sleeve of silver, or even a monster box of silver, or 10 silver coins or whatever, he said, those people, they report they don't have any money. So what a change that's been in just 3 years, 2.5 years. And so this idea of laying off the worst performing 10 to 15%, identifying them and then laying them off, even if you don't need to. Jack Welch and the current tech CEOs consider it's a healthy thing to do. I don't know, I just look at it, I was a CEO, but I look at it from the employee's point of view. This is a horrible thing to do to people. I think it's a horrible thing to do to your culture. You become a culture of cutthroat. And in the long term, I just don't think that's healthy.
The practice of stack ranking employees might be making a comeback in Silicon Valley. Kate Rooney joins us now with the latest for today's Tech Check. Hey, Kate.
Hey, Leslie. So after massive waves of tech layoffs, employees may have thought their jobs were a little safer. That might not be the case at this point, with new forms of stack ranking making a comeback. This is where you rank employees on a bell curve and then cut the bottom portion of those. It was made famous by the late Jack Welch, the former CEO of GE. It's sometimes called rank and yank. Tech companies have been bringing it back in different forms as a means to keep headcount in check during these new years of efficiency. And heading into earnings, discipline and cost discipline is really a big theme and what investors want to see across tech. So names like Amazon, Alphabet, Meta have all cut double-digit percentages of their workforce after overhiring during the pandemic. They all use some sort of employee rating system. The information also reporting that Shopify is now using a numeric rating system, then Only those whose scores increase in a review period are eligible for raises, according to the report, which Shopify executives are pushing back on. The return of what some see as a more cutthroat internal rating system does signal a shift, though, in tech company culture. So back in the pandemic, they overhired and they were fiercely competing for talent. And then came the end of zero interest rate that really changed the hiring landscape dramatically. Companies started laying off thousands of workers. You can see in that chart there, the layoffs really peaking early last year. Tech companies now need to prove that efficiency, and they've been awarded for some of the cost discipline layoffs. Not just big tech, though. You got Coinbase, Square, PayPal, all of those companies have gone through sort of the same structure of layoffs, and you've seen it reflected in the stock price, guys.
There used to be, I'm going to attribute this to Jack Welch, and I may be doing so incorrectly, that there was a feeling that you culled the weakest 10 or 15% of the herd every year. Is that where these tech companies seem to be going?
It does seem to be that strategy, this sort of, instead of going through these rounds of layoffs, is almost pruning of the workforce. And it's seen as, in some ways, a meritocracy. There are people out there that like this and say that's the fair way to do it. You also hear about something called a PIP, a performance improvement plan. So that's common in tech. That if you hear, I know, Tyler, hopefully you're not on a PIP right now. But it's where it's kind of seen as like the Grim Reaper coming. It's the signal that you're probably going to get laid off, but they will give you the opportunity and say, all right, here's your opportunity to go and improve your performance, but it's seen as a negative in tech. And Leslie, this might resonate covering the banking sector, but I've talked to folks who say, this also happens in banking.
Yep.
Goldman Sachs, for example, if you're not a top performer, you're not going to get that bonus and you're probably going to be let go. But it's less explicit. These tech companies have implemented these new systems and ways to rate people, and it's easier to kind of prove and quantify in finance. If you're not a top trader, it's easy to say, okay, listen, you're looking at the P&L. Leslie's bringing in the most as far as trading. Kate's kind of underperforming. We're going to get rid of Kate. Whereas in engineering, it's a little bit more subjective, and it's a lot more team-oriented. So the downside of some of this stack ranking can often be less collaborative, has been the negative commentary around it. And there's been studies out there that prove that it's not effective. So kind of a divisive topic.
So finally, I want to give you a positive view. So I've talked about some trouble that I think is ahead of us, and that's true. I do think it's ahead of us. I don't know when. We haven't talked timelines here. Probably in the coming few years, but I don't know for sure. David McAlvany, by the way, in his commentary said he believes that we will hit a recession, just an economic recession, 100% chance in the next 2 years, and a 50% chance this year, 2024. So he's a smart guy. I don't know if that's true or not. I try to stay away from that very much, but here's a positive view. And this was done with Andres Garcia Amaya. And I've not played anything from him before. I've not read anything of him. He seems very credible to me. He's the CEO of Zoe Capital, and he gives an optimistic view. And he says the market is going to hold up. It's pulled back recently. And by the way, let me comment on how much it's pulled back. So we've had a pullback for the last 2 or 3 weeks. How much? The S&P 500 has come down 5.5%. That's not much. We got out of the market in our investing models early last week, and we're out now. But we will get back in when it starts to show some strength. But, okay, so 3 weeks of some kind of a pullback, 5.5%. The NASDAQ down 8%. Okay. So that's in the category of a correction or pullback. It's not. Now, having said that, I will say this, that every bear market and every decline begins with a 5.5% S&P pullback. So you don't know how far down it's going to go. That's why we get out. We don't try to second guess that. Is it going to go to 10 or 15? I personally don't think so. And this Andres, he does not think so either. But we don't know. I can't tell you that I know for sure. So we don't take any chances on that. We're definitely about preserving capital. So anyway, it's a positive view. So I'll just play it and let you listen to it. Take a listen.
Sort of nodding your head when Steve said that Mohamed Al-Arian said maybe the Fed's talking a little too much.
Well, I think they were a little bit too dovish maybe getting into this year, and now they're kind of reacting to your point to what retail sales, jobs, something like 3 data points. It seems to have re-anchored a little bit. Ultimately, if you kind of read through the noise, if the economy holds up and inflation takes a little bit longer, I think the markets will hold up. They're now having a little bit of indigestion because of the change of language, but the Fed doesn't control what GDP or earnings are going to do. Maybe they did a couple of slip-ups one direction, and now they're kind of overreacting in the other, but they don't control, right, what earnings or GDP is.
Is the hiccup that the market has had, I'll get both of your opinions on this, do you think it is largely predicated on higher interest rates?
I think that if the big change would be if they now tell us that they might have to hike. I think that really would be a big change.
Otherwise, you think the market can continue to make headway. You've got a good economy, you've got good corporate profits, you've got inflation, okay.
Keeping all factors the same, meaning economy seems to actually be reaccelerating a little bit. Yes, inflation is a little stickier, but it's not necessarily reaccelerating significantly. I think the market holds up.
So here's my view on the market right now. My view is, here are the areas of risk, the areas that people are concerned about, and I think the reasons why the market has corrected. Inflation is staying stubbornly high. Interest rates have gone up. Therefore, bond yields have gone up. Therefore, bond prices have gone down. So making stock and bond portfolios probably worse than people were expecting. Geopolitical tensions in the Middle East. Iran, Israel. That is kind of on hold as I speak, but any day now, it could escalate by either side. Debt, as I covered earlier, unsustainable. And the immigration issue doesn't seem like any good fix is being considered. Now I want to give you a few charts that I thought are interesting, that tell part of an economic story. What happened last week with the escalation of the tensions in the Middle East? The cost of oil, Brent crude, went up dramatically. Here's a chart going back to, mid last month? So this is about a 1-month chart. The price of Brent crude. You can see at the very end, the far right of this, the spike. That's what happened, the price of oil. The euro plummeted relative to the Swiss franc on the same news. The government 10-year bond yield dropped quite a bit, and you can see that at the end. S&P futures on Friday collapsed. The Taiwan Stock Exchange collapsed. You can see that to the far right at the bottom. This happened overnight because it was in Asia, because the tension was in the Middle East. Shifting gears, here's another thing that I thought was interesting. This is another chart. I'm just going to show it to you. Credit card balances that are past due. Okay, you get a credit card bill, you don't pay it. It goes after 30 days, past due. Look at where that number has gone to, and you can see it in the far right of the chart. So I saw this, I thought I would play it, and it reminded me of a quote. And this is the financial advisor saying to his client, your portfolio is well diversified. On the chart it says the 3 categories of his portfolio are toxic, illegal, and risky. Well, it's an exaggeration, of course. But it reminded me of this quote from Warren Buffett, who said about diversification, and I want to talk about diversification. He said this, and he's emphatic about this: diversification is protection against ignorance. Diversification is protection against ignorance. It makes little sense if you know what you're doing. I completely agree with him. Now, Having said that, a level of diversification or a type of diversification is prudent. We would all agree on that. Warren Buffett would agree on that. He owns a lot of stocks in a lot of companies and in all types of industries. He's diversified, but he's diversified in stocks. And he has a method, it's not the method I use, but he has a method to deal with risk, to deal with equity risk, stock risk. And if you don't have a method to deal with stock risk, it's a very, very rough ride. Matter of fact, it's probably not even possible to deal with, because stocks eventually, or historically, stocks alone have taken a deep, deep dive, and sometimes they can go as deep as 50, 60, 70%. And a person should think of that kind of risk if you have only stocks. If you don't have a method to deal with that risk, that's the kind of risk you're facing. If you just buy it and forget it and it's only stocks, you are facing one day so much risk that I think you probably couldn't sleep at night. So diversification for that is prudent. But what he's talking about, I think, is he's talking about stocks and bonds. Bonds are generally the antithesis until we got to about 3 or 4 years ago, and then they became correlated. But generally, they move in an opposite direction from stocks, and putting those together, just those two together, provides a degree of diversification. And then traditional financial advisors will bring in energy stocks or precious metal stocks or something like that. So there is a way of dealing with diversification. What Warren Buffett is talking about is that kind of diversification. He does not believe in bonds at all, not 1%, zero on bonds. And good for him, because for the last 40 years, from 1981 to approximately 2021, that 40-year period, bonds have been going up, generally speaking, because yields have been coming down. So when paired up against stocks, which have generally also gone up, the mixture, back and forth mixture in a 50-50, 60-40 blend has been a decent portfolio. Bonds have put a pretty big drag on those portfolios, but if people accept that, it has worked out okay. The problem has come in 2022, or you could say 2021 to 2022. In that time period, we had hit a bottom on interest rates, which means that the bond prices had hit a top. So from that time forward, and you'll see it if you watch my video tomorrow, from that time forward, U.S. Treasury bonds and corporate bonds have been coming down a lot. I'm going to use a number, it's not precise, but approximately they've come down, the long-term bond has come down about 50%, approximately. That's a lot. That's not good protection against stocks. So, and as stocks have come down, bonds keep falling. So they are probably frustrating financial advisors. They won't tell you this, but I know they are. And they're frustrating investors, because that old approach is not working. It won't work as long as we are in a period of rising interest rates and rising bond yields, which means bond prices will continue to fall. And it makes yields in a good market terrible, and it makes prices or portfolios in a bad market negative. So not a good combination. So people are paying attention to this. Forget the spin that they're giving you. Just if you're paying attention to this, you know what I'm talking about. And the reason for this is the traditional portfolio and the attempt to get diversification that used to be there in the prior 40-year period that isn't there today. And it's taught in the business schools. They believe it to their toes. They will argue for it all the time. And they will say, well, yeah, but they are going back up eventually. It's terrible. Years ago, I had the privilege of a friend of mine who is, in my opinion, wealthy, very wealthy. he asked me to look at his portfolio. I knew he had a lot of money. It's obvious he had a lot of money. And when I looked at the portfolio, he had 100 or about 100 stocks and ETFs. He had everything but the kitchen sink. It was all there. Energy, technology, utilities, transportation, bonds, this kind of bond, that kind of bond. He literally had everything. And you could say he was very well diversified. No one would argue with that. And he would say he was very well diversified. I don't know how much downside risk he took. Today, he'd be taking quite a bit, but I don't know at that time how much he took. Probably not a lot of downside risk. But he said, Ben, in the 15 years or so that I've been doing this, I calculated my average rate of return. My average rate of return was 4% per year, average. Through ups and downs, we had some down periods, and we had some very nice up periods. So in both of those, average rate of return, 4%. That is just not acceptable to most people. Probably didn't even cover the rate of inflation. So yeah, you can get diversification. If you want diversification like that, where you get, everything working against each other, you'll get an anemic rate of return, and any financial advisor around will be glad to accommodate you. They can put you in all kinds of different things, but good luck feeling satisfied that it is producing much for you. Okay, well, thank you for watching. If you have questions or comments, leave them in the comment section below.